Capital is sprinting ahead of labor faster than any decade since the Industrial Revolution, and the forces behind it are more subtle than you think. Stay tuned, because number 1 reveals a shift almost nobody predicts. Automation is reshaping the workplace faster than anyone anticipated, with robots now handling tasks that once required skilled hands. According to industry reports, global investment in industrial robotics has surged past $70 billion this decade, a jump that reflects both cost savings and the push for higher productivity. Companies are deploying collaborative robots that work side by side with humans, reducing injury rates and extending operating hours without overtime pay. This shift also pressures labor unions, as fewer workers are needed for repetitive processes, driving wages down in sectors that cannot quickly adapt. Moreover, the rise of AI-driven quality control means fewer inspectors are required, further tilting the balance toward capital-heavy operations. Next, we'll see how the gig economy is turning traditional employment on its head.
Gig platforms are turning the labor market into a marketplace of short-term contracts, and the speed of that transformation is astonishing. In the past 5 years, the share of workers earning at least part of their income from gig work has climbed to roughly 30% in many advanced economies, according to labor surveys. This model shifts risk to workers while allowing firms to scale labor costs directly with demand, effectively converting fixed payroll into variable expenses. As a result, capital owners enjoy greater flexibility and lower overhead, while workers face income volatility and limited benefits. The gig surge also fuels the rise of digital payment infrastructure, reinforcing capital-centric ecosystems. Up next, we'll explore how remote work is cementing a new normal that further advantages investors over employees.
Remote work has become the default for millions, and its ripple effects are reshaping corporate balance sheets. Data from global real estate firms shows office vacancy rates have climbed by an estimated 25% since 2020, prompting landlords to slash rents and investors to reassess property valuations. Companies, in turn, are slashing overhead by cutting back on physical space, redirecting those savings into technology stacks that amplify productivity. This reallocation of capital strengthens shareholders, while employees trade commuting time for flexible schedules that often blur work-life boundaries. Moreover, the diffusion of cloud services creates a market for software subscriptions, a revenue stream that scales without proportional labor increases. Coming up, we'll examine how data-driven capitalism is turning information into a new source of wealth.
Data is the new oil, and corporations are mining it at an unprecedented rate to fuel profit margins. Companies that harness consumer behavior, supply chain metrics, and predictive analytics can fine-tune pricing, inventory, and marketing with surgical precision, squeezing out inefficiencies that once protected labor bargaining power. According to market analysts, firms that invest heavily in data infrastructure enjoy profit margins up to 5% higher than peers that lag behind. This advantage translates into higher shareholder returns while reducing the need for large workforces to manage manual processes. The commoditization of data platforms also creates a winner-takes-all dynamic, where a handful of tech giants control most of the valuable datasets. After this, we'll dive into the surge of artificial intelligence investment that's further amplifying capital's edge.
Artificial intelligence is being poured into with a fervor that rivals the dot-com boom, and the capital flows are unmistakable. Venture capital funding for AI startups topped an estimated $80 billion in 2024, a figure that dwarfs previous years and signals confidence in machines that can automate knowledge work. From chatbots handling customer service to algorithms optimizing logistics, AI reduces the need for human expertise across sectors. This automation translates into lower labor costs, higher output, and a surge in corporate valuations that reward tech-centric business models. At the same time, the talent race for AI specialists drives wages up for a tiny elite, widening income disparity. Next, we'll see how green finance and ESG criteria are reshaping capital allocation in ways that favor investors over workers.
Green finance has vaulted onto the investment stage, and the influx of capital into ESG-focused funds is reshaping how companies prioritize profit versus purpose. Assets under management in sustainable funds have surged past $35 trillion, according to recent industry reports, pulling billions into projects that promise environmental returns. While this green wave channels money into renewable infrastructure, it also creates new revenue streams for investors who can leverage tax incentives and premium valuations. Traditional labor-intensive industries, such as coal mining, face tighter financing and higher cost of capital, accelerating job losses in those sectors. Meanwhile, the emerging green tech sector often relies on capital-intensive automation, meaning fewer workers are needed to generate returns. Up next, we'll uncover how cryptocurrency and decentralized finance are further tilting the scales toward capital.
Cryptocurrency and decentralized finance have introduced a parallel financial system that sidesteps conventional banking, and the capital it attracts is staggering. Market data suggests that total crypto assets under management have hovered around $2 trillion, drawing speculative investment away from traditional equities and bonds. This shift empowers investors with near-instant, borderless transactions, while workers see little direct benefit beyond niche tech jobs. Decentralized finance platforms also enable tokenized assets and automated yield farming, which generate returns without the need for a large labor force to manage assets. Moreover, the rise of tokenized ownership models threatens traditional corporate structures, concentrating wealth among early adopters and venture backers. Following this, we'll explore how supply chain realignment is reshaping the balance between capital and labor.
Supply chains have been re-engineered in response to geopolitical tensions and pandemic disruptions, and the outcome favors capital efficiency over labor stability. Companies are investing heavily in automation, AI-driven inventory management, and nearshoring strategies that reduce dependence on large, low-cost workforces abroad. According to logistics analysts, the proportion of automated warehousing has grown by roughly 20% since 2020, cutting labor requirements and boosting throughput. This realignment also concentrates bargaining power in the hands of large logistics firms that own the technology, while smaller manufacturers struggle to compete without significant capital outlays. The result is a tighter, faster-moving supply network that delivers higher margins for shareholders but leaves many workers facing job insecurity. Next, we'll examine policy shifts that have been deliberately crafted to tip the scales even further toward capital.
We just walked through the 10 forces that are quietly but powerfully nudging capital ahead of labor in this decade, from factories humming with robots to governments reshaping tax rules. Understanding these shifts gives you a clearer view of where the economy is heading and why traditional job models are being rewritten. If you found this breakdown eye-opening, hit the like button and subscribe so you don't miss the next mind-blowing list we drop each week. Which of these economic shifts do you think will reshape the future of work the most? Share your thoughts in the comments below.